Welcome to The Deep Dive, your shortcut to being truly well-informed. Today we're doing what we do best here at TalkTickers, cutting through the noise to bring you the critical insights from a recent earnings call. We're deep diving into the Q2 2025 earnings call for SET, a major global player in essential hygiene and health products.
Exactly. And this quarter for SET, it offers a really fascinating case study, actually. The broader market, well, it's been showing some mixed signals, hasn't it? Impacting even established players in this sector. So our mission today is to uncover how SET is not just, surviving, but strategically navigating this complex environment. We'll highlight management's responses to both the challenges and maybe some unexpected opportunities, too.
All right, let's unpack this then, starting with a snapshot of SET's Q2 performance. The headline numbers look, well, pretty decent. Positive organic sales growth at 1.9%. Total reported net sales for the quarter hit 4.7 billion SEK. But here's the thing that really jumped out at me. Their gross profit margin actually reached a record high level. Now, that's not just a strong quarter. It feels like a clear signal of their pricing power and rigorous cost control, right? Even in this tightening economy. That seems like a key differentiator when maybe some competitors are struggling on both fronts.
Oh, absolutely. That record gross profit margin, it certainly stands out big time. But it's crucial to connect it to the underlying dynamics. See, the adjusted EBIT margin was 13.7%. Now, while that is a sequential improvement from the last quarter, it actually represented a decline compared to the same quarter last year.
Okay, so a bit more nuance there.
Exactly. The nuance here, and it's a significant one, is that despite that strong pricing performance you mentioned, overall reported net sales contracted by just over 6.5%. And that's largely due to a substantial translation impact from the strengthening Swedish Krona.
Right, the currency headwind,
But
always a factor.
always a factor. And it's also notable that volume growth was, well, limited, increased only 20 basis points, which reflects that challenging economic.
So we're seeing a picture of resilience.
Yeah.
Yeah, in a tough market, but definitely with some undeniable headwinds from currency and broader consumer caution. Does that margin strength then, does it just sort of mask an underlying issue with volume or market share maybe? Or is it truly a sign of sustainable pricing power that SET can leverage going forward?
Well, look, I think it's probably a bit of both. But leaning towards sustainable power, the margin strength is definitely a testament to their pricing discipline, But the volume challenge, yeah, that means they're not fully capturing maybe all the market growth out there. That said, their strategic moves within the segments suggest they're building resilience, which leads us nicely into the individual business segments, actually.
Perfect. Let's dive into those core business segments then, starting with health and medical. This segment marked its 17th consecutive quarter of growth for medical solutions. 17. With particularly strong performance in wound care. That seems solid.
Very solid. Consistent performer.
And we also saw good growth in their incontinence care business across many markets.
Yeah.
However, they did face specific challenges. In the UK, lower cost competition gained ground, apparently. And in Colombia, due to government restrictions on healthcare funding. So some localized issues.
Right. Market-specific headwinds.
What really caught my eye here, though, was their expansion into bariatric sizes 3XL and 4XL in the U.S. What does that signify about their understanding of sort of underserved markets? Is that a niche with significant growth potential, do you think?
It's a fantastic point. That expansion and also their presence across different channels,
Yeah.
Allowing patients to buy products in retail if they don't get them through healthcare. That's key. It really indicates a clear strategic focus. And what's fascinating here is the underlying market context. Demand for all categories across health and medical, it continues to be high. SETI's strategic focus seems to be on marketing these holistic solutions that provide quality care at the, quote, lowest possible total cost for customers.
The total cost argument.
Exactly. It's not just a marketing slogan. I think it's a shrewd move. It lets them capture wallet share from both premium and value segments, sort of protects them from a race to the bottom while still having offers for those who just choose the cheapest product per piece.
That makes a lot of sense. Okay, and what about the profitability of health and medical? You mentioned management expects volume to pick up in medical solutions. What gives them that confidence when consumer spending is constrained elsewhere? Is there a specific demand driver or like a strategic lever they're pulling?
Good question. Well, for incontinence care, margins are stabilizing. Those past input cost hikes seem to have been compensated through pricing now, which is positive. For medical solutions, yeah, they do still need stronger volume growth to achieve those scale effects, But management believes most of the observed volume decline here is temporary. Their confidence seems to stem from specific project pipelines and channel shifts, particularly in certain hospital procurement cycles that were just delayed this quarter. They're anticipating those to normalize fairly soon.
Okay, delayed, not lost. Got it. All right, moving to consumer goods. This looks like, as you said, a bit of a mixed bag, but definitely with some shining stars. Strong growth in feminine care, for instance, strengthening positions in markets like Mexico, UK, Australia, apparently supported by a new tiering approach for pricing flexibility. Interesting term. And Bodyform Ultimate is coming to shelves in the UK, designed for heavy flows to trade consumers up to higher value products. That seems like smart product development.
Absolutely. And it seems to be driven by really impactful brand building, too. What's pretty remarkable here is that Set was recognized by the Cannes Lion International Festival of Creativity. They won 7 Lions for groundbreaking work in their feminine care category. Management emphasized this, saying it indicates future growth through impactful brand building, not just, product features alone.
Wow, 7 Lions. That's a huge creative win. Signals real brand strength. But okay, on the flip side, we're seeing continued weak development in baby care, low birth rates, persistent competitive pressure, increasing consumer price sensitivity. The usual suspects, I guess. Set is responding by accelerating promotional pressure and launching an upgraded product with softer leg cuffs. Is the promotional environment in baby care particularly aggressive compared to the other segments?
It is, yes. Management explicitly called it very aggressive in baby care, coming from competitors. In consumer tissue, they said it's quite normal. And for feminine and incontinence, the situation is also described as quite normal. So baby care is the hotspot. Set is adapting elsewhere, too. They gained another contract with Amazon, which kicks in Q4. And in consumer tissue, they're upgrading their premium just one product with coreless technology to adapt to that consumer price sensitivity across all tiers.
Adapting the assortment makes sense. Okay, shifting gears then to professional hygiene. This segment experienced lower demand, especially in the hotel and restaurant sector in North America. Restaurant foot traffic declined by 3.5% in early 2025, and hotel occupancy rates were slightly lower. That, combined with some contract losses due to price pressure, led to declining volumes overall. However, they also reported strong growth in strategic segments, which resulted in a favorable mix and positive organic sales growth. How does management reconcile those declining volumes with positive organic sales growth? Is that a sustainable strategy, just focusing on mix?
Yeah, that's a critical point, isn't it? How can both be true? Well, management noted that while overall volumes declined, the losses were primarily in the sort of low-end core assortment, not against their major competitors, apparently. So the strategic work they've been doing to restructure the business and focus more on strategic higher value segments, that seems to have played out very well from their strategic perspective. They're essentially prioritizing value over pure volume in some areas. Pricing discipline remains a priority, though they did signal selective adjustments will be made to fuel volume growth going forward, presumably in those strategic areas.
By focusing firepower. And their innovation efforts seem to be paying off here too, which helps that strategy. Torkomatic, the sensor dispenser for hand towels, now boasts a 6-year battery lifetime. That's up from 1 year. That's a huge leap, setting a new industry standard.
It really is. That removes a key barrier for customers using automatic dispensers.
And the Torque Opturv Coreless product, launched last year, has apparently been very well received. It's even present at Yankee Stadium now.
That's quite the placement. These innovations, they definitely demonstrate their commitment to staying ahead in those strategic product areas. And, if we connect this to the bigger picture, tariffs are also a factor impacting profitability in this segment, specifically Canadian tariffs. They're affecting professional hygiene's profitability by about 0.6% on the margin, because Set manufactures in the U.S. and sells into Canada, where local competitors don't face the same impact. So it's a notable headwind for them there.
Okay, another specific headwind to track. So after dissecting all the segments, this all begs the question of the company's overall financial health and the future outlook. What are the key trends you're seeing there?
Right. Let's try and synthesize the financial trends. For cost of goods sold, QGS, it's expected to be somewhat lower sequentially in Q3. That's due to positive raw material impact and picking up some savings. However, a slight caution. For the full year, savings are now more likely to be in the lower part of that 500 million to 1 billion SEK range they guided for, simply due to lower than expected volumes impacting savings realization.
Okay, volume impacting savings targets. Makes sense. What about expenses like A&M and SG&A?
Yeah, so advertising and marketing, A&M, is expected to increase slightly in Q3, both in absolute terms and in relation to sales, but not materially, maybe 10, 20 basis points. Management maintains a really firm belief here that investing in A&M is very profitable, driving both net sales and profit growth over time, so they're sticking with it. And selling, general and administrative, SG&A, that's expected to be flat sequentially in Q3. Although management did acknowledge that SG&A costs, particularly personnel costs and IT, are increasing too fast given the limited volume growth. That's leading to a less favorable margin impact than they'd like. They said plans are in place to ensure cost growth is contracted in future quarters, though interestingly, not by reducing the sales force.
Controlling costs without cutting sales capacity. That's a careful balancing act indeed. And what about cash flow and the balance sheet? Always critical for investors.
Right. Operating cash flow was 1.5 billion SEK in Q2. That was actually a bit lower than typical for the second quarter. And that was due to a temporary buildup in working capital, specifically accounts receivables and inventory. Management believes this is temporary. They expect to adjust inventory levels and see receivables pick up, sort of normalize, in the coming quarters. Net debt showed a slight increase quarter over quarter, but the company maintains, quote, very strong financial strength, end quote. And the year-over-year decrease in net cash flow, that was primarily explained by a technical factor. Dividends were paid in Q2 this year versus Q1 last year, and also much higher share buybacks happened in Q2 2025 compared to Q2 2024.
Okay, so timing factors on the cash flow, not necessarily a fundamental weakening. It sounds like SET is maintaining discipline, focused on the path forward despite some of these challenges. We've seen these strategic moves, but the new CEO is still relatively new to the role, right? Only 6 weeks in at the time of the call. What are their immediate priorities?
Yeah, good point. The new CEO highlighted key priorities for the rest of the year. Essentially, it's about continuing to execute the existing strategy, no major pivot announced, but with a specific focus on measures to, one, reduce cost levels, addressing that SG&A point we just discussed, and two, accelerate profitable volume growth, so finding ways to boost that top line effectively. A core emphasis will also be on strengthening customer and consumer focus further within the organization, aiming to support speed and agility. So really, it sounds like optimizing the existing framework rather than, some radical overhaul.
A clear roadmap then. Steady execution. Okay, this all leads us to perhaps the most intriguing part of our discussion today. How do these deep insights translate into concrete opportunities for the astute investor? Now, remember everyone, this is not financial advice. This is just a thought experiment, letting our inner hedge fund analyst out for a moment for the sophisticated investor listening. Given Essity Q2 earnings call, particularly that stark contrast we saw between the structurally challenged baby care segment and the robust growth in areas like adult incontinence and medical solutions, well, we've identified a bold yet plausible trade idea.
Indeed. Consider a paired trade. It's based directly on the dynamics discussed in the call. On one side, you could consider shorting a pure-play baby care manufacturer, especially one with significant exposure to regions experiencing those low birth rates or intense promotional pricing pressure that SET clearly flagged. SET's call really highlights the systemic headwinds in this segment, suggesting a challenging environment that probably won't easily resolve soon.
Okay, short the challenge segment and the other side of the pair.
The other side is going long SET itself. This is essentially a bet on its diversified portfolio, its demonstrated pricing power across multiple categories, which we saw in that gross margin, and also its aggressive innovation in those higher margin strategic segments like medical solutions and adult incontinence. These are areas where underlying demand remains high, and Essiti's holistic solutions seem to provide a distinct competitive edge.
Right. So the trade capitalizes on the market's potential, perhaps, overemphasis on broad macro headwinds hitting certain categories, while maybe underappreciating Essiti's specific strengths and adapting its portfolio, executing that pricing discipline, and driving innovation in these resilient growing niches. It's really a bet on strategic management overcoming targeted sector turbulence, a true deep dive into potential market inefficiencies. And that wraps up our TalkTickers looking at Essiti's Q2 2025 earnings call.
Yeah, we've seen a company navigating a pretty complex market with, I'd say, strategic precision, leveraging its strengths in core hygiene and health products while actively addressing challenges in specific areas like baby care and some parts of professional hygiene. That commitment to cost reduction and profitable volume growth, coupled with a renewed focus on customer needs under the new CEO, that will definitely be key to watch in the coming quarters.
Absolutely. Well, thank you for tuning in and gaining, hopefully, a swift well-informed perspective with us today. And just a reminder, this conversation is for informational purposes only. It should absolutely not be considered financial advice. Always do your own research or consult a financial advisor before making any investment decisions.
That's right. We make no representations or warranties regarding the accuracy, completeness, or reliability of any information presented here. Our insights are based on factual data from the earnings call, but the presentation, it might include some creative commentary for engagement.
So what stands out to you from Essity's Q2? How do you think their focus on strategic segments and cost efficiency will play out in the coming quarters? We genuinely love to hear your thoughts. Until next time, stay curious and stay informed.